Welcome back to The Climb. We've gone from tax basics in episode 4 to deductions and credits in episode 5. Now we go advanced. Optimizing strategies, how to handle capital gains, taxes if you work for yourself. Multi-year planning in this 2026 world. This is where high earners and investors save the most. It ties everything together from this series and connects you to investing from episode 3 and what we need to do to maximize our fiscal situation. So let's get right into it.
Life is full of choices, but how do all these choices connect? And how do we plan for what matters most? Because when your life goals align with the right financial strategy, you don't just dream, you climb.
Quick recap of the series so far. In episode 4, we discussed progressive tax brackets, standard deductions, and withholdings. In episode 5, we discussed itemizing versus standard deductions, credits like the child tax credit, and bunching strategies. Now advance to the next level. This is for people with investments that grow, side hustles or self-employment, higher incomes where taxes bite a lot harder. In 2026 household, debt is still high. Markets are volatile, but reward those with long-term capital gains and those who are patient with the markets. Advanced planning turns those gains into even more wealth, not less after taxes. Let's keep it clear and practical. Capital gains are profits from selling investments like stocks, ETFs, crypto, real estate. Short-term gains are held for 1 year or less, and they're taxed as ordinary income rates, up to 37%. Long-term rates are held for more than 1 year. They get lower preferential rates, 0%, 15%, up to 20%. And it depends on your taxable income. For single filers, long-term capital gains rate is 0% if your income is up to $48,350. 15% if your income is from $48,351 to $533,400. And if you make above that threshold, you pay 20% on long-term capital gains. For those married filing jointly, 0% up to $96,700, 15% from $96,701 to $600,050, and 20% thereafter. Now, for those that are paying 20% or above on long-term capital gains, you pay the 20% capital gains, plus you may pay an additional 3.8 net tax called the net investment income tax. So let's talk about strategies. Strategy 1, hold longer. Turn short-term gains into long-term gains. This saves big on taxes. Strategy number 2, tax loss harvesting. Sell losing investments to offset gains. You can deduct up to $3,000 of net loss against ordinary income. And any additional losses you can carry forward for the future years. So I'll give you an example. Let's say you have a net capital loss of $100,000, and hopefully you don't, but if you did, in that fiscal year, you can deduct $3,000 of those $100,000 against your ordinary income. But you still have $97,000 in losses. Those losses carry forward into the next year. And if you have capital gains that year, they offset those gains by the $97,000. If there's still a remainder balance, it keeps carrying forward and forward until you exhaust 100% of that realized loss. This can be a helpful way to move between volatile markets. Many investors review their portfolios annually for opportunities like this. It is worth considering if this fits your overall strategy. If you work for yourself, freelance, side hustle, if you own a business, you have to pay self-employment tax, which is about 15.3%. This covers Social Security and Medicare. As a self-employed person or a business owner, you pay both the employee and the employee parts of taxes. So this is important to understand. If you're an employee of a company, your employer pays half of the tax, you pay the other half. But if you work for yourself, you pay 100% of this tax on your own. But you can deduct half of that on your return. You must make quarterly estimated tax payments also to avoid any penalties. So use Form 1040 ES online as a tool. Other deductions for self-employed persons are things like a home office, if you have a dedicated space, mileages. Standard rate for mileage is around 67 miles per mile. Business supplies such as marketing, equipment. There's a lot of advanced deductions that you can make. That is a conversation that you can have with your CPA is what is a qualified business expense and deduction. So take that opportunity. The tax code was literally written for businesses to take advantage of deductions. And it's not something that you will easily learn overnight, but have these conversations so that you can deepen your understanding of what qualifies and doesn't qualify as a deduction or business expense. Another important point to consider is alternative minimum tax, known as AMT. It's a parallel system that can hit you if you have high deductions. Unmarried individuals or those single head of households, $90,100. Married filing jointly or surviving spouses, $140,200. The federal lifetime exemption, which is also known as the basic exclusion amount or unified credit for estate, gift, and generational skipping transfers, known as GST, is for $15 million and above per individuals in 2026. But most people never see estate taxes, right? But that doesn't mean we don't plan for these things, because these things are always changing. We've had different administrations that have outright abolished estate taxes. Some look to enact them. It really just depends. It's a very political concept that we should always keep our eye on and plan accordingly. Taxes aren't just 1 year. Smart people plan across years. Roth conversions move money from traditional IRA to a Roth IRA. You pay taxes now on the converted amount in exchange for future growth and qualified withdrawals that are tax-free. This can make sense if you expect high tax rates in the future, or expect to inherit more assets, or want to leave a tax-free inheritance for your heirs. Traditional IRA contributions are also worth considering. On the other hand, you get a deduction now, so it lowers your current taxable income. It grows tax deferred until you withdraw. The best choice always depends on your current tax situation. Take into consideration your bracket versus your expected future bracket. This is a very specific, a situation-specific consideration, right? Because every family is a little bit different, every person is a little bit different. But you always want to ask yourself at the core, when do I think I'm going to pay higher taxes, today or tomorrow? And based on that, it should guide you whether you should do a Roth or a traditional contribution. Another consideration is qualified charitable distributions, QCDs, from your IRAs after age 70 and a half. You can send money directly from your IRA to a qualified charity. It counts towards your required minimum distribution, but it's not included in your taxable income. This is a powerful way to give while reducing taxes. Inflation adjustments. Brackets rise each year, but plan for possible future changes. The Tax Cut and Jobs Act extensions are in place, but watch for new laws. Remember, things are always changing. The system's never the same. We have different politicians' ideas of how to navigate our national debt, the different programs that we fund, or geopolitical scenarios. So be aware of these things, because they will affect the way you navigate your tax scenario. And if you're not to date, make sure you have these conversations with your financial advisor, your CPA, or preferably both. Key takeaway from today: advanced tax planning protects and grows your wealth. 3 actions for this week. First, review your investment portfolio. Look for losses to harvest before year end. Second, if self-employed, calculate your quarterly estimates. Make sure you're on track. Third, consider Roth conversions or traditional IRA contributions potential. Run rough numbers, outlines, but always consult a pro first. And now, next episode, the series finale. We bring CPA Richard Duran. He'll recap everything, engage in conversations on key points, answer common questions, and tie this to your overall climb. Plus, he'll break down the big, beautiful bill and the latest changes to the tax code that you need to consider. Stay tuned, because this is going to be a big one, and we have a lot of things to talk about. See you next time.
Life is full of choices, but how do all these choices connect? And how do we plan for what matters most? Because when your life goals align with the right financial strategy, you don't just dream, you climb.